Start your business investing in crypto. Cryptocurrency is a type of digital or virtual currency that uses cryptography for security, making it difficult or nearly impossible to counterfeit or double spend. It operates independently of a central authority or government, which makes it decentralized and typically operates on a technology called blockchain. Here's a detailed breakdown. 1. What is cryptocurrency? Cryptocurrency is a form of digital currency that exists solely in the digital realm. It doesn't have a physical form like coins or banknotes, and it relies on encryption techniques for secure transactions, regulation of new units, and verification of asset transfers. 2. Key features of cryptocurrency. Decentralization. Unlike traditional currencies, fiat currencies like the USD EUR, which are regulated by governments or central banks, cryptocurrencies are typically decentralized. This means there's no central authority that controls the currency, which theoretically reduces the risk of manipulation and inflation. Blockchain technology. Most cryptocurrencies are built on a blockchain. A blockchain is a distributed ledger that records all transactions across a network of computers, nodes. It's secure, transparent, and immutable, meaning that once information is entered into the blockchain, it cannot be altered or deleted without consensus from the network. Security and cryptography. Cryptocurrencies use cryptographic techniques to secure transactions. Public and private keys, digital signatures, and hashing algorithms ensure that transactions are secure and that users can trust the system. Transparency and anonymity. While blockchain transactions are transparent, anyone can view the transaction history on the blockchain. The identity of the users involved in these transactions is often pseudonymous, relying on cryptographic addresses rather than personal information. Global accessibility. Cryptocurrencies can be used globally without needing traditional financial institutions like banks. This makes it possible for people in regions with limited access to banking systems to participate in the global economy. 3. Popular cryptocurrencies. Bitcoin, BTC, the first and most widely recognized cryptocurrency, created in 2009 by an anonymous person or group known as Satoshi Nakamoto. Bitcoin introduced the concept of decentralized currency and blockchain. Ethereum, ETH, launched in 2015 by Vitalik Buterin and others, Ethereum is a blockchain platform that enables smart contracts and decentralized applications, dApps. It also has its cryptocurrency, Ether, ETH. Binance Coin, BNB. Initially created as a utility token for the Binance Exchange, BNB has expanded to serve multiple purposes, including powering the Binance Smart Chain. Cardano, ADA, a blockchain platform that aims to provide a more secure and scalable infrastructure for the development of decentralized applications and smart contracts. Ripple, XRP, focuses on facilitating cross-border payments and remittances, offering faster and cheaper alternatives to traditional financial systems. Litecoin, LTC, often referred to as the silver to Bitcoin's gold, Litecoin was designed to offer faster transaction confirmation times. 4. How cryptocurrencies work. Mining. In the case of Bitcoin and other proof-of-work cryptocurrencies, miners use computational power to solve complex mathematical problems. When a problem is solved, a new block is added to the blockchain, and the miner is rewarded with cryptocurrency. This process requires a lot of energy and computing power, but it ensures network security. Proof of stake, POS. Some cryptocurrencies, like Ethereum, after its merge update, use a proof-of-stake mechanism where participants can stake their coins to validate transactions and secure the network, earning rewards in return. POS is considered more energy efficient than proof of work. Transactions. Cryptocurrency transactions are made between digital wallets. A wallet contains a public key, like an account number, and a private key, like a password. The sender signs the transaction with their private key, which is then verified by the network and recorded on the blockchain. 5. Advantages of cryptocurrencies. Decentralization. No central authority controls the currency or transactions, reducing the risk of interference, manipulation, or centralized failure. Lower transaction fees. Cryptocurrency transactions typically have lower fees compared to traditional banking or payment methods, especially for cross-border payments. Fast and borderless transactions. Cryptocurrency transactions can be processed within minutes, regardless of geographical location, making it ideal for international transfers. Privacy and security. Cryptographic techniques make cryptocurrencies secure and difficult to counterfeit. Additionally, many cryptocurrencies offer a degree of privacy, with users transacting under pseudonyms. Access to unbanked populations. Cryptocurrencies can be accessed by anyone with an internet connection, making them an attractive option for people without access to traditional financial services. Risks and challenges of cryptocurrencies. Volatility. Cryptocurrencies are known for their price volatility. While they have offered significant returns in some cases, they are also subject to dramatic swings in price, which can result in substantial financial losses. Regulatory uncertainty. Many governments around the world are still figuring out how to regulate cryptocurrencies. Some countries have banned or severely restricted their use, while others are adopting more open regulatory approaches. Security risks. Although blockchain technology is secure, the cryptocurrency ecosystem is not immune to fraud, hacks, and theft. Exchange hacks, phishing attacks, and other forms of fraud have led to significant losses. Environmental impact. Mining cryptocurrencies like Bitcoin consumes a considerable amount of energy, leading to concerns about the environmental impact of proof-of-work systems, scams, and fraud. The crypto space has been plagued by scams and fraudulent schemes, including Ponzi schemes, fake initial coin offerings, ICOs, and rug pulls. Cryptocurrency use cases. Digital payments, cryptocurrencies can be used to make purchases and transfer money, providing an alternative to traditional banking and payment methods. Decentralized finance, DeFi. DeFi platforms use cryptocurrency and blockchain to offer financial services, lending, borrowing, trading, etc., without intermediaries like banks, non-fungible. Tokens, NFTs. NFTs are unique digital assets representing ownership of digital or physical goods, and they are often built on platforms like Ethereum. Cross-border transactions. Cryptocurrencies can provide an easier and more cost-effective method for international payments, bypassing banks and traditional remittance services. Smart contracts. These are self-executing contracts with the terms of the agreement directly written into lines of code. Ethereum is the most prominent blockchain for executing smart contracts. Future of cryptocurrency. The future of cryptocurrency is still uncertain, but its potential impact on global finance, technology, and society is undeniable. Possible developments include integration into mainstream finance. As cryptocurrency becomes more widely accepted, it could be integrated into traditional financial systems. Regulation and legal frameworks. Governments are expected to establish clearer regulations for the crypto industry to address issues like fraud, tax evasion, and consumer protection. Scalability and sustainability. Improvements in blockchain technology, such as Layer 2 solutions and energy-efficient consensus algorithms, could address scalability and environmental concerns. Central bank. Digital currencies, CBDCs. Some central banks are exploring the creation of their own digital currencies, which could operate alongside traditional cryptocurrencies but remain under the control of central banks. Conclusion. Cryptocurrencies represent a transformative technology that has the potential to reshape global finance, offering benefits such as decentralization, privacy, and global access. However, they come with significant risks, including price volatility, regulatory uncertainty, and security issues. As the market matures and technology advances, cryptocurrencies are likely to play an increasingly important role in the global economy.